Hey everyone, welcome back to Trade Radar USA. Today we're talking about one of the biggest fears investors have right now. Is the stock market headed for a crash? We're breaking down the latest Yahoo Finance analysis and the key signals you need to understand what might happen in 2026 and what it means for your money. If you're invested, curious, or concerned, stay tuned and make sure to hit that subscribe button and turn on notifications so you never miss a market update. So what exactly is being said? According to recent financial analysis, the stock market is historically expensive, meaning valuations are stretched higher than usual, which increases the odds of a significant downturn. This has analysts warning that a crash isn't impossible going into 2026, especially under current economic conditions and political uncertainty. At the same time, these same sources point out that the market is also hitting new highs, and history doesn't guarantee a crash just because prices are elevated. So there's a balancing act between the worry and the facts. Here are some of the main red flags analysts are watching carefully. 1. High valuations. When stocks get really expensive compared to earnings and economic growth, it leaves less room for error. That's historically been linked to corrections or crashes. 2. Rising interest rates and yields. If rates stay high or go higher, borrowing costs rise, and that can squeeze corporate profits and investor appetite. 3. Inflation and economic stress. Unexpected inflation spikes or major macroeconomic shocks can weaken markets fast. 4. Market bubbles, especially in tech, AI stocks. Some investors fear parts of the market, think AI-linked stocks, are overhyped. If that bubble bursts, it could drag the broader market down. Here's the key takeaway. A crash is not guaranteed. In fact, many economists and strategists still expect growth. Some even predict new all-time highs because central bank policies and technological advancements continue to support markets. Plus, market corrections happen all the time, usually smaller and less dramatic than crashes. So investors need to understand the difference. Okay, let's clarify the difference. Correction, a drop of about 10 to 20% from recent highs. Still painful, but relatively normal. Crash, a rapid and steep collapse, 20% or more, usually driven by panic and systemic stress. History shows us actual crashes are rare, while corrections happen more often as part of normal market cycles. Looking back, crashes like Black Friday 1989 or the 2008 financial crisis were driven by very specific economic stress points, leverage, credit breakdowns, or external shocks. The lesson? Crashes are not random. They emerge when multiple risk factors align. If you're watching this worried about your portfolio, here's what disciplined investors actually do. Diversify so you're not overly exposed to one sector. Think long-term, markets historically recover over time. Don't try to time the crash. That's extremely difficult, even for pros. If you want deeper strategies tailored to your situation, let me know in the comments. Tech and AI stocks have been among the biggest drivers of market gains, but also among the most volatile. Some analysts warn that if this sector corrects sharply, it could trigger larger downturn pressure. That doesn't mean the whole market crashes, but it could shake confidence. This is exactly the kind of risk we're watching as we go into the next year. So what's the bottom line? A major stock market crash in 2026 is possible, but not set in stone. There are warning signs, but also stabilizers. Smart investors prepare, they don't panic. If you want more market breakdowns, investment insights, and strategy content, make sure you subscribe to smash that like button and ring the notification bell. You won't want to miss what's coming next. Drop a comment below. Are you watching the market nervously or staying calm? I want to hear from you.